Welcome back, everyone. Traditional debt markets are constrained, prioritizing risk minimization over returns. Private credit changes the game, unlocking higher yields, bridging the credit gap, and offering structured, secured lending beyond conventional investments. Unlike traditional fixed income options, private credit delivers 500 to 600 BPS higher returns, addressing the underfunded mid market segment where banks hesitate. It provides predictable cash flows insulated from daily market volatility, ensuring low correlation to public markets. Hybrid mutual funds mix equity and debt but remain exposed to market fluctuations. Private credit, however, offers a fixed income alternative with structured downside protection and diversified lending strategies. As we explore this asset class, the question isn't whether private credit works, it does. The real question is how can investors best position themselves to benefit from this structural shift in lending? Let's dive in. Our eminent panelists are Mr. Rohit Rathi, the principal real estate business at ICICI Prudential AMC, and comes armed with over 2 decades of experience in pan India real estate investments. Prior to this, he led the mortgages business at IPAMC and served as zonal head for corporate realty finance at ICICI Bank, managing real estate assets worth over $1.2 billion. A chartered accountant, Mr. Rohit also holds a postgraduate degree in commerce from Jodhpur University. We have with us Mr. Nachiket Naik, the head structured credit at Alternates by Axis AMC. Mr. Nachiket is a seasoned professional with over 2 decades of experience in corporate lending, structured finance, and debt capital markets. Leading the structured credit division at Axis AMC, he is responsible for fundraising and investment strategies for private credit funds, having been a founding member of both Arca FinCap and IREP Credit Capital. Mr. Nachiket has consistently focused on bespoke structured debt transactions, positioning him as a pioneer in the private credit space. We also have with us Mr. Dipen Ruparelia, Head of Products, Vivriti Asset Management. Mr. Dipen is a founding member of Vivriti AMC and heads its product division, where he oversees fund launches in the performing credit space. With 15 plus years of experience spanning debt markets, fundraising, and fund management, Mr. Dipen has built a reputation for launching innovative funds both domestically and offshore, solidifying Vivriti AMC's standing in private credit. A CA and CFA by qualification, his expertise bridges products and performance seamlessly. And, ladies and gentlemen, this session will be moderated by Ms. Lakshmi Iyer, who is the CEO of investment advisory business at Kotak Investment Advisors Limited. She has been with the Kotak Group for over 23 years. Prior to joining Kotak, Ms. Lakshmi worked with Credence Analytics Private Limited as a research analyst, where she was tracking corporate bond markets in India and generating research reports. She holds an MBA degree in finance from Narsi Monji Institute of Management Studies. She has been recognized as one of the top 25 most influential women in asset management in Asia by Asian Investor. What a privilege to have you here today. Over to you, Ms. Iyer.
Thank you so much, and very good evening to all of you. I think Aishwarya has very nicely introduced all the panelists and the topic of our discussion today. So I think I don't want to really get into that job for now, but I think. The topic of today's discussion, obviously, we all know what it is. Just to put some numbers in context before I jump to our, fellow speakers, if you look at the size itself, in 2024, we are tops of $9 billion, 163 deals. And this is not my data, this is EY data. And this is the India information that I'm sharing with you. While globally, we are seeing mixed patches, I would say. When I say mixed patches, I'm saying US is seeing some upgrade in growth, Euro is seeing downgrade in growth. Indian credit market, what do I say? If I were to give you a Bollywood analogy, it is actually moving in from a gully boy to a Salar status. I don't know if any of you have watched any of these movies. Is basically Gully Boy. There's this very famous song, rap song, which says "Apna time aayega," and from that status to a Salar. Salar is obviously the captain or the leader or the hero. Where there was a very famous dialogue. I don't know who all have seen it, but तेरे लिए शिकार भी बनूंगा, शिकार भी करूंगा. So I think that is what the status the Indian credit markets have, in terms of where we are today, specifically on the alternate side. My first question, therefore, to you, Nachi, is okay. I call him Nachi, but Nachiket
Please.
is what are the key factors driving this trend? Is this a fad or a future?
No, thanks. And I was waiting for the Bollywood analogy. So thanks to start off with that. No, see, the way I look at it, I mean, credit markets in India have historically been bank enabled. Anything which kind of was difficult for the banks to do purely from a regulatory and not from a risk perspective was part meal, adjusted by the bond markets. Historically, bond markets, all said and done, have played the high investment grade space, the AAA, AA. A lot by way of the single A, triple B space was played by the NBFCs. Given last few years how the whole valuations from a capital market perspective have stacked up for NBFCs doing wholesale lending, I think a lot of them by default, including banks, frankly, have moved towards more small ticket lending because that's been flavor of the season, which then leaves a bit of an unaddressed area by way of non-bank end-use requirements not addressed by the bond market. NBFCs don't want to do it. Who does it, right? And that's where patient capital in a close-ended format becomes a logical answer. And I think that's what's driven this whole upsurge in private credit platforms. And you've got all sorts of players trying to address it. You've got the AMCs, you've got the NBFCs setting up these platforms, you've got the asset managers, you've got wealth distribution firms. I think it'll evolve. It's been all of 3-4 years old. Over the next couple of years, it will evolve. And currently, calling it performing space, everything from 12 to 18%. I think you'll get two segments, the 13, 14, which is more classic NBFC like, which AMCs would love to do. And then the 18, 20%, which falls naturally into the lap of asset managers. The LPs also who will fund them will become 13, 14 will be more institution driven, 18, 20 will be more FPI and family office driven. So the space will evolve and settle over the next couple of years, but it's here to stay. Globally, debt is bigger than equity. In India, it's just about warming up. And exciting times ahead.
So it is not like a Coldplay which comes and goes, but it is more like an Arijit Singh, which is more everlasting and evergreen.
Evergreen, absolutely.
Awesome. Rohit, would you have similar views given the fact that you run a very successful real estate practice at your firm? Real estate, if I talk about Indian investors, two asset classes which they have, I call the magnetic pull, chumbak effect, is actually real estate and gold. And in that sense, real estate is actually the shehenshah in probably everyone's personal portfolio, and these days even corporates, because they all want to move into own premises from lease premises. My question to you is that are you seeing investor participation here on the fund side, given the fact that Indians love to own real estate, and is the fund route as exciting for all of these investors?
Yeah, Lakshmi, you have correctly pinpointed it. This is real estate is the largest asset class in the world. It is the oldest asset class in the world. And this asset class is close to everybody's heart. Everybody has a view about it because we stay in a house. So typically you have a view on this asset. The question which you asked, first is residential real estate is very simple and everybody is connected to it. So most of us actually relates to residential real estate. There's another part of real estate which is called as commercial real estate, which is your offices. Okay. So like Nachiket is saying, real estate is seen always as an asset class where you should try to make the higher teen returns rather than lower teen returns. So it will be special situation rather than performing credit in private credit markets. If you see, what has happened is office space where you can get regular rental incomes. There's a regular appreciation in the rental incomes, and you can make returns out of a steady asset, which typically, if you see globally, this is owned by insurance companies. So most of the rent yielding assets are owned by institutions which are insurance companies and REITs. However, what happened in India is REIT has just evolved 4 or 5 years back, and we have got just three REITs. So investors didn't get full opportunity to invest in this asset class. However, a lot of new age AMCs and some of the fund managers have come up with the product which they call as office rent yielding strategy, which is again similar to your performing credit markets where you try to get between 15 to 18% returns. So this strategy is now available. Lot of we are gung ho about this strategy since we are at a interest rate cycle where probably we have peaked out on interest rate cycle, and any interest rate reduction positively benefits the commercial real estate, especially office and steady income thing. So currently there are a lot of opportunities through which people can invest in this asset class also. We
So
also
so basically, you're trying to say, Rohit, that Rajni in double role, Rajni equal to real estate in double role is
absolutely
also something which people are very happy to own, whether it's in physical real estate format or
or in
in.
unit format.
So ye dil mange more basically.
Absolutely, absolutely.
Awesome. Dipen, I'll come to you next. My question is slightly different from the earlier two questions. One is, and if I talk about market parlance, there is a main board listing versus SME listing. In movie parlance, there is a theatrical release versus an OTT release. My question to you, why I took this analogy, is to ask you, what is the relevance of these kind of strategies in an investor portfolio? Are these main board or theatrical, or they still remain OTT or SME in investors portfolio?
Yeah, I think a very important and a good question. So, in my sense, I think performing credit is part of core strategy asset allocation, and it's covers. So, in an asset allocation, you have as basically three fundamental major classes. You have debt, you have equity, and you have gold, some extent of commodities, right? Within debt, you have public market debts, which are mutual funds, bank FDs, and then you have access to private markets, which is access and enabled through alternative investment funds and private credit. And within private credit, there are various risk return strategies per se, right? Now, in my sense, this is the core part of the debt allocation. And over a period of time, investors have realized, and especially sophisticated and accredited investors, that traditional fixed income products actually now, one, the interest rate environment in India is also sort of low. And especially for investors who are sort of falling in a high tax bracket, the traditional debt products actually don't sort of end up covering even the post-tax, post-inflation returns. And today, most of the traditional products actually are offering close to negligible post-tax, post-inflation. And even when we are sort of looking at inflation, the right barometer is not the one which is sort of published by RBI. Yours and my inflation, and most of the people on this call, the inflation rate is in fact very, very high. So it's actually part of a very, very core allocation within debt. And private credit strategies are fundamental because in terms of correlation to the other asset class, which is equity, where those are susceptible to large volatility drawdown, private credit actually works as a sort of bringing down the overall portfolio risk because their correlation to equity market is actually virtually as close to nil. Which means that in the market environment like we are today, right, we've seen markets declining by 15-20% from peak. However, private credits tend to offer steady, predictable returns. And most of the funds will sort of target 14-15 gross headline, where the investors will still have uh, low to mid-teen sort of returns, right? So I think it's a very, very important allocation if within the debt allocation. And investors over a period of time obviously know where within their risk return framework, whether they are part of the risk is lower, moderate, and aggressive. And I think even within the low and moderate and aggressive, private credit actually deserves an allocation.
In fact, Dipen, you touched upon a very important point that there is that need for diversification, but not as much. But as you were speaking, and Nachi, this question is to you. I was actually, have you seen this movie, Teri Baaton Mein Aisa Uljha Jiya? Have you seen the movie by any chance?
Not really.
Not really? Okay, then you must go and watch, because it is not real. It is actually AI. It is artificial, because the hero is actually romancing Kriti Sanon in that movie, and she is actually a bot or a robo.
Okay.
And why I asked you this, or why I gave you this analogy, is that are we seeing investor preferences also moving? And what's been your experience since you've run successful practices across firms in private credit? Is the trend very vehement that people are moving from traditional strategies to alternate strategies? Because after this movie, I have not seen any more male heroes romancing bots on silver screen. So hence the question to you.
Sure. No, absolutely. And, it really comes from a perspective that investments have predominantly been public equity markets, and alternates, in a manner of speaking, were not really on offer. Today, you've got within alternates, you've got credit, you've got real estate, you've got infra, you've got private equity, you've got venture debt. So bouquet. And to that extent, I think that's where the rigor of asset allocation comes into play. That's where the institutionalization of investing and advisory comes into play. The institutions adapt to it much more quickly. You talk to the insurance companies, and you see that even in their 3% allocation to alternates, they've got various pockets. I think family offices will take some time, given that the urge to chase the highest return asset class kind of at times dilutes discipline. But over a period of time, as, for example, investment professionals start running family offices and it becomes more policy and process driven, you will see a good mix. And, like Dipen mentioned, it's playing to different pockets of risk and return. And it's not that every asset class kind of gives you that same mix. So to have that balance and to have an equal distribution which satisfies your risk appetite need, it's here to stay. I think personally, if I look at it, incrementally allocation has clearly been towards alternates as against public markets, given the fact that anyway allocation to public markets for a lot of people historically have been overweight equity, because that was by far the only available asset class. So I think it's good to have options. It's good to have balance. And at the end of the day, it's good to have institutional approach and advice which guides you towards this kind of mix.
No, absolutely. I'm with you on that. But Rohit, I have a question for you, which is a related question. And this risk reward that we keep toggling. Again, movies, there is an anti-climax, there is a climax. To every hero, there is a villain. In movies like Dar, Shah Rukh Khan acts as the hero and the villain. How do you, this balance part, which Nachi rightly spoke about, how do you maintain this balance, the risk and reward metrics? And more importantly, how do you really protect the investor downside? Are there some guardrails that you look at when you are choosing any of these investing companies?
Yeah, of course. We need to see, as an asset manager, this is our prime job actually, to protect investors' interest, at the same time get the best return for the lowest risk which somebody can take. So that is actually the large parameter which is there. As Nachiket said, see, asset allocation is a key, and see, each asset class has its own risk and rewards. So what an investor has to see is how much risk he can take. Accordingly, the reward will be there. What commercial real estate offers is a regular annuity income, which is similar to your bond yields, which you can say. However, there is appreciation also possible because the rentals keep on escalating. Since we are in a high inflation environment, the rentals also keep on. So if I have to see a yield product strategy in a real estate, in that we at AMC have a triangle based approach. We call it the triangle approach, where there are three large parameters. First is property itself, or office asset which is there. A quality office asset or a grade building or a nicely done building always fetch a premium over the other buildings, and the rentals are much higher. Second, in a yield asset, tenant is a key. Say, tenant is MNC or GCC or some of the tenants with strong balance sheet, typically they tends to in same office for a longer period of time. And in fact, some areas are actually named after the tenant because you have to go next to the Microsoft building. So tenant is a second important pillar. And third is micro market. There. So how people are colored is typically we see cities. All these seven large cities, if you see in India, there are micro cities in each city. So if let's say Mumbai, I think so there would be at least 8 to 10 micro markets, and each micro market is as large as any of tier two city. Each of these micro markets also behave very differently. So some of the micro markets would have outperformed, some of the micro markets would have underperformed. So as an asset manager, we have to choose the best micro market. So if you see these three put together, the center of three would be the best property, best tenant, and the best growing micro market if you take. So your growth, your escalation and rental yield much higher, and so you can expect a better return in that. So we try to maximize on all the three parameters which I said.
Man, this is so important, to the point which Rohit rightly mentioned, because see, we run, for example, at Kota calls the country's largest real estate fund. And every time in the investment committee, we have very, very similar conversation because there's always investor mindset, ye dil mange more, shareholder mindset, ye dil mange many, many more. And then finally, when I'm the investor fund manager mindset, how do you make sure that that more becomes no more? I think you have to ensure that it does not go to that stage, and therefore the return of capital is so very, very important. And I would say it's not just for the RE sector; it's across sectors. Yeah, and Dipen, I want to bring you in. And again, pardon my Bollywood analogies, but if you look at the top ranking actors in 2024, you'll be surprised. You will still see Shah Rukh right at the top, followed by Allu Arjun, of course, and then we have the Khan brothers, which is Amir Khan or Salman Khan, etc. And of course, further down, you have the Tollywood guys like Vijay, you have Shahid Kapoor, and these guys. In sector parlance, if I take this, extend this analogy, are there any particular sectors which you see investors are making a beeline for within your funds, or you see your manager's preference or your institution's preference trying to make a beeline towards and saying that main hu na is not really the thing, it is Pushpa fire hu main, which is the Allu Arjun factor, which is more at play right now?
Yeah, I think at Rathi, for example, we run predominantly sector agnostic funds. So there are some sectors where we are sort of overweight, and there are some sectors which we are sort of underweight, and largely sort of playing through the macroeconomic cycle, right? I think over the last 2 years, for example, and post-COVID, we've seen a lot of infrastructure thrust from government in terms of capex, and the infrastructure thrive in terms of capital allocations being extremely high. So we've seen, for example, a lot of deal flows within infrastructure at our end, in terms of telecom infrastructure, airports, roads, for example. So those sectors, for example, where the risk reward makes sense, and there is a positive government push. For example, we've seen a lot of thrive and push on renewable energies, right? And that's one of the large themes which is sort of playing out not only in India but across the world, right? So we've had deals in those segments. There are certain sectors, for example, which are going through difficult periods, right? So over the last 7 to 10 years, we've seen massive lending by banks and NBFCs. And Nachiket mentioned that over a period of time, actually the last decade, if you see, the cycle has been extreme growth in retail lending. And if I just quote some numbers, banking lending to personal growth, for example, was almost like 16% CAGR. NBFC's loan growth was almost like 23% CAGR. So a lot of money, for example, have moved to retail lending. sectors like NBFCs and MFIs, for example, especially are going through a difficult period. So there, for example, MFI, for example, especially is an underweight with so it's actually playing along with the cycle. And there are obviously certain sectors which have also historically seen a lot of governance issues, textiles, jewelry, for example, media, those where we sort of remain underweight permanently. Yeah.
So basically, you're saying that there is, एक म्यान में multiple तलवार रह सकते हैं. Basically,
Yeah.
every actor has his role to play, and therefore every sector will definitely. And I think even today the credit fund that we run, which is close to little under $200 million, it's cut across about 8 to 9 investments, and there is no one sector which has a significant weighted. So I'm completely with you on this, Dipen. Rohit, my question to you is, since you also have a successful mutual fund practice, between a hybrid category fund and say a credit RE or any fund, or where the yields are north of 18 to 20% in gross, is the hybrid category somewhere feeling that मैं Cinderella हूँ, मतलब step treatment compared to real estate?
Not exactly. See, both the products, if you see now, they are not comparable. See, mutual fund as a product, it is more for retail investors. So if you see the investors profile would be very different who invest in hybrid. They offers liquidity, they offers transparency in terms of monthly fact sheet, etc. And depending on the fund manager, you can you are actually giving money to fund manager to accordingly allocate the funds into different asset classes. What AIFs are doing, or some of these real estate or current trading funds and private credit funds are doing, is they are putting directly into a specific sector and trying to get returns out of that specific asset class. So I will explain you. Here in the hybrid fund, it is actually you are giving to fund manager, and fund manager is deciding on your behalf. Here, where a lot of professional asset allocators and fund managers are there who are specifically managing a specific asset class, then as a advisor, you can advise him. Say your portfolio should be divided in based on your risk appetite. This much percentage into debt, this much into equity, this much into real estate, this much into commodity, and then for each specific asset class, you have a specific asset manager who is managing. So you are getting the best of specialization in AIFs. Hybrid funds are giving a general advice. I will say it's a general treatment, and these are the specific treatments. Hence, there is always an alpha written between a hybrid fund and AIF. At the same time, there are lock-ins also which are there, which a lot of these retail investors doesn't want, and they need more liquidity at some point of time. However, a lot of HNIs and ultra HNI we've seen, they wants to they are happy with the longer term commitments, and but they want alpha returns. So it is a balance which is there. So I cannot say, you cannot compare hybrid one with some of these. These are absolutely two different actresses. These cannot be matched. One is South Asia, another is Bollywood types.
Or one to say one is Madhubala, other is Madhuri Dixit. Both are evergreen, but but the fact of the matter is that both have been evergreen in their own era. And one also needs to remember, as an investor, that these category 2 funds that we are discussing, with this real estate or private credit or special situations, they are all like Abhimanyu, which is into the Chakravyu. Abhimanyu died, we know that, but the intent where all the noble souls which are discussing the strategy piece today will ensure that you come up victorious. So I think that is very critical. And on the victory note, Lakshmi, my final question to you is, do you think the industry has the necessary astra shastra or the brahmastra to ensure that this trend continues and gets into from a Brahma status, like creator of this entire category, and sustain for the long term?
So talking about private credit specifically, and that applies to alternates in general, given that both industries are relatively new, have a bit of a Valentine sort of thought to that, with the fact that I think it's early days, and in early days, when there is an attractiveness to the asset class, it draws players of all, kind of attributes, in a manner of speaking. But as one goes a long time, things don't remain rosy forever. My biggest worry is that till now, we've had no accidents, touch wood, in any of these alternate asset classes, including private credit. Uh, the dreamy situation doesn't last forever. An accident tends to further institutionalize and formalize an industry. It separates men from boys, but in the intervening period, it has an impact on sentiment, especially given the fact that a lot of these funds are still funded by non-institutional players, where sentiment makes a big impact on their investment decisions. My only worry is that it doesn't take them off the table for a period of time, given that that might be the first time they're experiencing things not going as per plan. So to that extent, as an asset class, here to stay. By way of the linearity of growth, well, it's never going to be linear. And I hope the majority of investors to tolerate or to understand and appreciate that things can't just go one way, and in a larger scheme of things, see the value of the asset class is what will kind of ensure the longevity of this asset class.
No, I think very, very well summarized. And I can say this, having toggled between the mutual fund industry, helming the investment piece for about 2 decades plus, and now leading the alternates piece at Kotak Alternates, and having successfully launched and run strategies ranging from special sits to real estate to even the performing credit. I can say that roses are red, violets are blue, but the credit mood is going to be evergreen. So it's not about the blues or the violets or the reds right now. And if I were to summarize this very interesting conversation, and I'll try and I'm talking very extempore because I've had a really long day today, is I think the Halla Bol by all the Yodhas in this room has been already done, and the clarion call, I would say, is that while the Brahmastra, as the major astra for this industry, is yet to be unraveled, but the credit investment Maidan is wide open. So if you have the jigra, just come and fall in love, because today is the day of love. So yes, fall in love with this category. Trust me, there will not be a ditching moment. Thank you so much. On that note, I hand over the stage to Aishwarya.